For U.S. emergency services, agencies, and the military in rural and remote regions, the stakes couldn't be higher. Every day, these hard-working Americans put their lives on the line to serve and protect this nation and its citizens. Yet connectivity is often missing when and where they need it most. AST SpaceMobile's pioneering space-based cellular broadband technology could help close crucial gaps in disaster recovery, wildfire fronts, border security, conflict areas, forward operating sites, at sea, and more. Here's how. For emergency responders, AST SpaceMobile's planned satellite direct-to-device connectivity could help streamline response and evacuations when traditional networks go offline or don't exist. To smoke jumpers fighting wildfires, real-time data on rapidly changing conditions could offer a clear, safer path through smoke and flames. At borders, where security is paramount, yet internet is lacking, broadband connectivity from orbit could enable smart monitoring and help maximize limited resources. In coastal waters beyond the reach of cell towers, broadband data could mean the difference between lives saved and lost, or threats thwarted or undetected. Up in the sky, a new means of connectivity could harden in-flight defenses and help keep busy airborne travel lanes clearer. In distant military outposts, those who serve could stay better connected, more ready to defend and protect. And far from home, they have a space-age way to stay in touch with loved ones. Our team has already proven that technology works. We've achieved multiple historic feats, including two-way voice and video calls over 4G LTE and 5G, as well as more than 21 megabit per second download speeds directly from space to everyday smartphones. Now, we're building the world's first and only space-based cellular broadband network, a fleet of satellites designed to work like cell towers with ordinary mobile devices on the ground. Our Bluebird satellites will have the largest ever commercial communications arrays in low Earth orbit, with the capability to provide up to 120 megabit per second peak data rates. Our innovation may benefit not only mobile end users by providing broadband connectivity in remote areas, but also enhance the work, operations, and capabilities of government agencies. AST SpaceMobile is an American company that's committed to providing secure, reliable, broadband-capable connectivity solutions, especially to our nation's most dedicated. But we're not going it alone. Our industry-leading strategic partners include AT&T, Bell Canada, Google, Verizon, and Vodafone. We also have agreements with more than 45 mobile network operators around the world, who together have access to more than 2.8 billion subscribers. We are AST SpaceMobile. A more connected world, with all its limitless possibilities, is just over the horizon.
Wow. Welcome back to Strongman Personal Finance. So we got a sponsored video today, and this sponsored video requestor, besides compensating me with $50, wanted me to go over the financial statements of AST SpaceMobile, bro. And if you want a sponsored video, check out the pinned comment. It's $50. So, as we just saw, this company is launching a bunch of satellites into space, or they plan to at least. And with these satellites, you're going to have internet, mobile connectivity. You're going to be able to place phone calls anywhere in the world. So if you're in the desert riding your camel about to raid a caravan, you could call Muhammad Jalil and coordinate your assault. You could do basically, you could do whatever you freaking want, okay? You could be in the middle of the ocean fighting off Jaws floating in the water, and then you call the Coast Guard, and ASTS will save your freaking life, okay? It's an amazing, beautiful technology. And it actually is. Like, there is an appeal to it. I mean, imagine that. You ever go through a place where you have, like, terrible service, or you're hiking, you know, because most of you probably don't hike because you're fat and lazy. But imagine you're hiking, you know, and then you get, like, your leg torn off by a bear, and you need help, but you're out of connectivity. Well, if you have connection to a satellite, you could call from anywhere. So it's a pretty interesting concept. It kind of sounds like SpaceX, but whatever. So over the past year, the stock is up 753%. That's why it's popular. Don't ask any questions. Don't overthink this. This stock is popular because it's up 753%. Is there some substance to it? My answer is maybe. Now, the first thing, when we look at the overall financials of this company, is that they have no freaking revenue. Okay? Excuse me. In the most recent quarter, they had $900,000 of revenue. Why is that? This is still a very speculative investment, okay? This company is planning to make deals with all these different mobile phone providers and service providers, okay? I don't think you can contract or buy a plan directly from ASTS, but ideally in the future, ASTS provides services to Verizon, AT&T, and those services trickle through those companies to you as the end user. So you could probably like buy an additional plan, et cetera, et cetera. In the future, once they establish the network, have they established it yet? No. Okay, that is the speculative nature of this investment. is they have to get a bunch of satellites into space, hope they don't freaking blow up, and then after that, stay afloat, hopefully make a bunch of contracts with Verizon and AT&T, and hopefully there's enough interest from people to make this happen. Now, it would be a total disaster if these things went up in space and, like, nobody freaking wanted it, okay? Or very few people wanted it. Because most people, I mean, like, being able to call from anywhere is great. But if I had to pay $20 extra a month, I don't know if I would do that, to be perfectly honest, because I don't really go that far into the wilderness, okay? So there's a lot riding on this. The satellites get into space. It works as planned. People buy it, okay? There's a lot going on here. In the meantime, there's basically no revenue being generated. In the most recent quarter, they incurred $63 million of expenses. Okay? This is a massively cash-burning business. Now, what are some of the plans, okay? So, they talked about blah, 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 blah. And they're about to launch these Bluebird satellites. Okay, they're going to launch 17. And I guess they're launching a few in September is the last I heard. So they're about to launch these satellites into space. And theoretically, at some point, they're going to be able to, start generating revenue at some point in the future. Okay, let's read this. So Abel Avelian, his accent is horrible, said in an August 14th earnings call with investors, the first of 17 Block 2 Bluebird satellites would be ready to launch in the first quarter of 2025. I don't know where I saw that somewhere. Somewhere it said September. But they're not even, they haven't even launched the freaking satellites yesterday. And they have to get 17 satellites into orbit. Okay? What if one or two or three of them blow up? There's risk in this, okay? So let's go through the financial statements, okay? Financial statements are important. So first of all, cash. This business is sitting on $285 million of cash. So while they are unprofitable, they generate no revenues, they're burning cash, they have a decent amount of cash. And a big chunk of that came from Verizon, I believe. Okay, that's $285 million of cash. That's a war chest. They got $2 million of restricted cash, $7 million of prepaids. So basically, they have $315 million of current liquid asset, mostly liquid assets, basically all of it's cash, which is good for a business like this. Current debts due within a year, this is just for accounts payable, accrued expenses, contract liabilities, is $49 million. So apparently they do have some contract liabilities or performance obligations that will eventually become revenue that they have to perform at some point in the future. They're saying that within the next year. Okay, I think they talk about it in a little bit. So they're able to meet their short-term debts within the next year. That's fine, okay? Let's look at their long-term assets. So they have property, plant, and equipment of $248 million. A lot of that is satellites, okay? I think they have a couple satellites up right now, and the vast majority of it is satellites they're building. So they have to build the satellites on time. They got to launch them into space. Hopefully they don't blow up. Hopefully they work. Hopefully ET doesn't stick his pipe in one of them. There's a lot that could go wrong, okay? But most of their assets are in cash and in satellites. Makes sense, okay? A few leases. Okay, let's look at long-term debts. So they have warrant liability. So basically, a warrant gives you the right to purchase shares at a certain point. So they have to recognize a warrant liability on their balance sheet, and that's going to fluctuate with earnings. But I wouldn't worry about that too much. What I would focus on is the cash flow. That's what matters for this. You're hoping this business survives long enough, doesn't burn through all its cash before it can get the whole system working. That's the first baby step. And you can see they packed on long-term debt. They increased their long-term debt from $59 million to almost $200 million in the course of 6 months. And that's, of course, to buy satellites, okay? We also see additional paid-in capital and common stock go up because they issued an F-ton of shares to help them stay alive and to make satellites, okay? Now, here we have the income statement, okay? So once again, in the 3 months into June 30th, they recorded a total loss before income tax of $131 million. Okay, now a big part of that was because of the remeasurement of warrant liability. So that's what I said. So warrants are basically, they're saying at some point in the future, we're going to have to potentially give out stock, okay, when people exercise their warrants. So this is going to fluctuate massively. And when the liability goes up, that's almost like you have to debit something to offset it. It's like a loss. So you're going to see these huge fluctuations, okay? But if you focus on the operating expenses, that's what I think truly matters. You know, of course, interest expense and income, but it doesn't seem to be that significant, at least yet. Now, we can see there's a flip in interest income. So they had interest income of $1.7 million, and that flipped to interest expense because they took out a lot of debt, okay? So total operating expenses are up. Good, what, 10%? Something like that. They're up a good 10%. And let's see. And shares, they've doubled the number of shares. So when you invest in a business like this, they're just going to be packing on debt or they're going to be issuing shares. Dilution is massive. There's warrant liabilities. There could be massive potential dilution in the future as this company, you know, either succeeds or fails. I mean, either way, I think you're going to be diluted pretty significantly. So this is like a reconciliation of, you know, where the shares are coming from. It's mostly share issuance and restricted stock units. So let's look at the statement of cash flows. This is what I think is most important because on the income statement, you're going to see these wild fluctuations with warrant liabilities. So the first thing you're going to see is depreciation and amortization. That's added back. Why? Because it's a non-cash expense. Depreciation is recognizing the cost of the satellites over their useful lives. I hazard a guess that most of their depreciation is from their frickin' satellites. And we can see there's a huge increase because now they're putting their satellites into service. That's what they're doing. Once you start using the satellite, you have to record depreciation. But the cash, when you paid for it, that's in the past. They already paid the cash for it. Now they're spreading out the cost of that asset over its useful life. So depreciation has jumped massively. Amortization of debt issuance costs. These are costs. You spread out there's some additional costs that are incurred with debt. You got to spread them out over the loan. This debt issuance costs. You amortize them. Loss on disposal of property and equipment. What do they dispose of? That's interesting. They had a loss. And, of course, a massive, massive loss because of warrant liabilities. Once again, this is going to fluctuate because it all depends on the share price. I would hazard a guess that if the share price goes up, the warrant liabilities are going to go up. That's the guess I would have there. But in a sense, yeah, it can lead to potential dilution. But when you look at it from an expense perspective, it's not a cash flow. So I wouldn't freak out about that too much. Focus on the cash flow. This is what reconciles it. Stock-based compensation is up. And then paid-in-kind interest expense. That's interesting. So I think paid-in-kind interest expense, they're not paying interest, but what happens is the interest portion that's due, they just add that to the loan. So instead of saying, oh, you got to pay $100 of interest this month, they just, now you owe $100 more. It gets added to the principal of the debt. That's what it looks like there. Okay, then we see, changes in the balance sheet, current assets, current liabilities. That's normal. Overall net cash. So in 6 months, they burned $64 million of cash just in operations. On top of that, they spent $61 million on property, plant, and equipment. So in 6 months, they burned $125 million in 6 months. They're going to burn, if they keep this pace up, they're going to burn through that cash pile real quick. Now, where'd all the money come from? Well, they issued $145 million of debt, and they issued $189 million. They generated $189 million of cash from stock. So basically, when you buy a stock from this company, you're just throwing money at them and hoping they spend it, and hopefully everything works out. You're not getting any profits for the foreseeable future. Keep that in mind. And there's probably going to be more debt and stock issuance events in the future, assuming everything, even if everything works out. All right, so we know what they do. They talk about, we did this and it worked. We did this and it worked. But, they're not even fully operational yet. Like, they still have to get everything into freaking space. Okay. Let's see. Fair value measurement. Okay, this is explaining how they calculate their warrant liabilities. I wouldn't worry about that. Focus on the cash. Focus on the cash burn. And focus on the freaking satellites actually getting into space. Property, plant, and equipment. Now, where's most of their fixed assets? Well, satellites in orbit. So, funny enough, they didn't even depreciate. Is this the gross amount? Net. Why are they not depreciating their satellites in orbit? That's weird. So they have satellites in orbit already, but they haven't recognized them. They haven't recorded depreciation expense. well, okay. You're not using it? Are you? Are you not? I mean, I guess technically they're not, but it's already in freaking orbit. That's weird. Just my thoughts there. But they haven't recognized any depreciation on satellites in orbit. They're just, I guess, they're not technically in service yet. Let's see. And then construction in progress. So they've spent $164 million so far on satellites that they're constructing, putting together, and advanced launch payments that they haven't done yet. So, oh, no, here it is. It's before accumulated depreciation. That makes sense. I was like, what? Okay. So they probably are depreciating the satellites in orbit. But their total property, plant equipment, they spent $347 million on their property, plant equipment. And they've recognized $100 million of accumulated depreciation. The vast majority of the long-term assets is the satellites that they're building right now. It's half of it, roughly, a little bit more than half. For a total property, plant equipment of $248 million. I wonder what the useful life of this satellite in orbit is. Because they have to spread this cost over a certain amount of time. I wonder what they project, how long these satellites are going to last before ET shoves a schlong in one of them and blows it up. Okay, they issued convertible notes. So they raise money through stock issuance, and they raise money through convertible notes. Convertible notes means that the lenders can convert the notes into stock. Let's see. The company issued subordinated convertible notes for an aggregate principal amount of $110 million to AT&T, Google, and Vodafone. It's Italiano. And for an aggregate principal amount of $35 million to Verizon. Okay, so all the big boys are in on this, okay? And if the stock does well, they can convert their notes into stock. The notes bear an interest rate of 5.5%, semi-annually in arrears. The company has opted to pay interest on the convertible notes in cash in kind. Okay. The company selected to pay interest on the convertible notes in kind on June 30th, resulting in the principal amount of convertible notes being increased by approximately. You're going to see the debt going up because instead of paying interest in cash, they're just adding it to the debt. And then at some point, that's going to have to be paid in future. The AT&T, Google, and Vodafone convertible notes have a 10-year term. 10-year note. Okay, so they got plenty of time. They got plenty of time to... Hey, man, if this company works out, AT&T, Google, and Vodafone are going to do pretty freaking good, okay? The holders of the notes may convert the notes at an initial conversion rate of 173 shares per 1,000 of principal. That's a lot of future shares that can be generated. I mean, holy freaking crap. What is the, let me see if I don't screw this up. Let's see. 110 plus 35 million, 145 million divided by 1,000 times 173, 913. So if I did my math right, this could, if these all get converted, this could generate 25 million additional shares. If I did my math right. I just did that on the fly. Let's see. How many shares do they have right now? How many shares? Basic and... Oh, well, I guess they wrap it up into here. But basically, you've been diluted by 100%. You've been, like, double diluted holding this stock before they issued all this debt to Verizon or got this debt from Verizon and all these other freaking companies, okay? So, I mean, there's really not much more to say. I mean, this is a very speculative investment, okay? You're basically hoping a bunch of things go right. I'm not saying they can't go right, but you need to understand what you're doing. This thing could wildly fluctuate. If a launch doesn't go as planned, this stock could freaking plummet, okay? You're hoping at some point in the future, all the satellites get into space, all these cell companies contract with them. You're hoping that all the, people actually use the service on the end. You hope the satellites don't blow up in space. There's a lot of risk. And in the meantime, this company's burning cash and diluting. Okay, this is a very speculative investment. Don't be a clown, okay? So anyway, that's my thoughts on this. If you want a sponsored video, check out the pinned comment below. It's $50. If you want a one-on-one tutoring session with me, I'm a certified public accountant. I can teach you financial statements, $75 an hour. See the pinned comment. And check out my book, Stop Being a Broke Loser. It's on Amazon. It's awesome. It's amazing. Just like me. Have a wonderful night. Cheers.